There is a book that has quietly changed the way some of the greatest investors in the world think about money, about companies, and about the future of wealth building. And that book is called Common Stocks and Uncommon Profits, written by a man named Philip Arthur Fisher, who spent decades studying businesses, talking to people inside and outside companies, and developing a method of investing that was so clear, so practical, and so powerful that it still works today, even though the world has changed dramatically since Fisher first put his ideas on paper. Philip Fisher was not a flashy man. He did not appear on television every day. He did not shout about stock tips, and he did not promise quick riches to anyone. But what he did offer was something far more valuable, and that was a way of thinking about businesses that could help an ordinary person become an extraordinary investor over time, if that person was willing to be patient, to do real research, and to think long and hard before putting their money into any company. Fisher started his investment career in the late 1920s, and he lived through some of the most difficult periods in financial history, including the Great Economic Crash of 1929 and the Long Depression that followed it. And these experiences shaped him deeply. They taught him that investing is not a game of luck, not a game of timing, the market, not a game of buying what everyone else is buying, but rather a deep and serious discipline of understanding what makes a business genuinely great, and then having the courage and patience to hold that great business for a very long time. When Warren Buffett, one of the most successful investors who has ever lived, was asked about his investment philosophy, he described himself as being roughly 85% influenced by Benjamin Graham, who taught the world about value investing, and about 15% influenced by Philip Fisher. But many people who study Buffett's actual investment decisions carefully say that the Fisher influence is far more visible in his greatest and most profitable investments. And this tells you something very important about the power of Fisher's ideas. So let us walk through the world of common stocks and uncommon profits together, in plain and simple language, exploring every major idea Fisher put forward, understanding why each idea matters, and seeing how these ideas can help you become a wiser, calmer, and more successful investor in your own life, wherever you are in the world, whatever stage of life you are at, and whatever amount of money you have to invest. Fisher believed that the single most important thing an investor can do is find truly great companies, not good companies, not average companies, but truly great ones. Companies that have what it takes to grow their sales and their profits year after year for a very long period of time, because when you find such a company and buy its shares at a reasonable price, time itself becomes your greatest ally, and the longer you hold those shares, the wealthier you become. This sounds simple, and in a way it is simple, but the difficulty lies in knowing how to identify these truly great companies before everyone else has already discovered them and pushed their share prices to levels where there is no more profit left for you to make. And this is where Fisher's method becomes so valuable, because he developed a very specific and very practical way of researching companies that very few people were doing at the time. He wrote his book, and that method is called the scuttlebutt method. The word scuttlebutt comes from old sailing ships, where sailors would gather around the barrel of drinking water to share gossip and information, and Fisher borrowed this word to describe his method of gathering information about a company by talking to many different people who have knowledge about that company from many different angles. And this method is one of the most powerful ideas in the entire book, because it teaches you that the best information about a company does not usually come from reading the company's official reports or listening to what the company's managers say about themselves, but rather from going out into the world and asking questions of people who deal with that company every day. Fisher said that if you want to truly understand a business, you should talk to its customers, its suppliers, its competitors, its former employees, its current employees where possible, scientists and researchers in the same industry, and anyone else who has direct experience with that company's products, services, culture, and management, because each of these people will give you a piece of the puzzle. And when you put all those pieces together, You will have a much clearer picture of that company than you could ever get from reading financial reports alone. The idea is this. If you are thinking about investing in a company that makes industrial equipment, for example, you might talk to the purchasing managers at factories that buy that equipment and ask them whether this company's products are better or worse than the competition, whether the company's sales and service people are helpful and reliable, whether the company is known for innovation and new products, or whether it is falling behind, and the answers you get will tell you something that no financial report can tell you, which is whether this company has a real and lasting advantage in its market that will keep customers coming back again and again. Fisher was not the first person to talk to company insiders and industry experts, but he was one of the first to turn this into a systematic discipline and to explain exactly how to do it and what questions to ask. And this is one of the things that makes his book so enduringly valuable, because the questions he suggested asking are just as relevant today as they were when he first wrote them. Now, let us go deeper into the heart of the book, which is Fisher's famous 15 points. These are 15 specific qualities that Fisher believed a company must have, or at least most of which it must have, in order to qualify as a truly great investment. And each of these points tells you something important about what separates an extraordinary business from an ordinary one. The first point is about whether the company has products or services with enough market potential to make possible a sizable increase in sales for at least several years. And what Fisher is asking here is very simply this. Is there room for this company to keep growing for a long time? Or is it already at or near the limit of what its market can support? Because a company can be very profitable today and still be a bad investment if there is no room left for future growth. So you want to find companies that are still in the early or middle stages of what could be a very long and successful journey. Fisher gave examples of companies that looked like they had reached their peak, but then found entirely new markets or new applications for their existing products and went on to grow much larger than anyone had expected. And this is an important lesson because it reminds you that a great management team can often find ways to extend the life of a growth story far beyond what seems obvious at first glance. And you should look for companies whose managers are always thinking about how to serve their customers better and reach new ones. The second point is about whether management is determined to continue to develop products or processes that will still further increase total sales potential when the growth potentials of currently attractive product lines have largely been exploited. And what Fisher is really asking here is whether the company has a strong commitment to research and development, because in the modern world, no company can rest on its current products forever. The world changes, technology changes, customer needs change, and the companies that survive and thrive over long periods are the ones that are always investing in developing new and better products and services. Fisher pointed out that the truly great companies are not the ones that simply ride one wave of a successful product and then fade away, but rather the ones that have built into their culture and their structure a relentless commitment to finding the next wave before the current one has finished. And this requires management that genuinely believes in research and development, that funds it generously even during difficult times, and that has the organizational ability to turn research into actual products that customers want to buy. He also noted that there is a difference between companies that do research just because it is fashionable and companies that do research because they genuinely believe it is the lifeblood of their future. And the investor's job is to figure out which kind of company they are looking at. And the scuttlebutt method is particularly useful here because the people who work in a company's research department or who work alongside it in the same industry can usually tell you whether the research is genuinely productive or whether it is mostly for show. The third point is about how effective the company's research and development efforts are in relation to its size. And this is really about efficiency, because a company can spend a lot of money on research and get very little from it, while another company can spend a modest amount and produce a steady stream of new and valuable products. And the investor should look for companies where the research spending is producing real results rather than just consuming money. Fisher said that the best way to evaluate this is to look at the history of the company's research output to see whether the research has led to actual new products that have been successfully commercialized, and to talk to people in the industry who can give you an honest assessment of whether the company's research team is genuinely capable and productive. And this again brings us back to the importance of the scuttlebutt method. The fourth point is about whether the company has an above-average sales organization. And this is a point that many investors overlook entirely because they focus so much on products and finances. But Fisher understood that even the greatest product in the world will fail if it is not sold effectively. And conversely, a company with a truly excellent sales organization can often outsell competitors, even when those competitors have somewhat better products. Fisher described what a great sales organization looks like, and it is not simply a large team of salespeople, but rather an organization that understands its customers deeply, that has built genuine relationships of trust with those customers over time, that provides excellent service after the sale, and that is constantly looking for ways to help its customers succeed. Because when you help your customers succeed, they become loyal customers who come back to you again and again and recommend you to others. The fifth point is about whether the company has a worthwhile profit margin. And here Fisher is making the point that a company can have growing sales but still be a bad investment if it is not actually making good profits from those sales. Because profit is ultimately what drives the value of a company's shares, and a company with a thin profit margin is vulnerable to any number of problems, including rising costs, increased competition, or economic downturns that can quickly turn a small margin into a loss. Fisher was also clear that profit margins vary greatly between different industries, and what counts as a good margin in one industry might be terrible in another. So you cannot simply compare the profit margin of a technology company to that of a grocery store and draw meaningful conclusions. You need to compare a company's margins to those of its direct competitors in the same industry, and what you are looking for is a company that consistently earns higher margins than its peers, because this suggests that the company has something special, some advantage that allows it to charge more for its products or to produce them more efficiently than its rivals. The sixth point is about what the company is doing to maintain or improve profit margins. And this is really about whether management is actively working to keep the company's competitive advantages strong. Because even a company with excellent margins today can see those margins erode if management becomes complacent, or if new competitors enter the market with better products or lower costs. Fisher said that the companies you really want to own are the ones where management is never satisfied with the current level of profitability, where they are always looking for ways to become more efficient, to develop better processes, to find new ways of serving customers that the competition has not yet thought of, because this kind of relentless drive for improvement is what allows a great company to maintain its advantages over long periods of time. And it is also a sign of the kind of management quality that Fisher considered absolutely essential to great investment outcomes. The seventh point is about whether the company has outstanding labor and personnel relations, and this might surprise some investors who have been taught to focus mainly on financial numbers. But Fisher understood something that modern research has repeatedly confirmed, which is that companies with excellent relationships between management and employees consistently outperform companies with poor labor relations over the long term. Fisher explained that a company with good labor relations has lower employee turnover, which means it spends less money training new people and retains more of the institutional knowledge and skill that has been built up over years. It has higher productivity because employees who feel valued and respected work harder and more creatively. It has fewer disruptions from labor disputes or strikes, and it has a culture that attracts talented people who have many choices about where to work. And all of these advantages compound over time into a significant competitive edge. He said that the best way to evaluate a company's labor relations is again through the scuttlebutt method, by talking to people who work there or have worked there, by looking at the company's reputation in its local community, by asking employees whether they are proud to work for the company and whether they feel that management treats them fairly, And the answers to these questions will tell you a great deal about the long-term prospects of the business. The eighth point is about whether the company has outstanding executive relations, by which Fisher meant the relationships between the top management and the people just below them in the organization. And this is really about whether there is a culture of developing talent from within, of promoting capable people, of giving people real responsibility and real opportunities to grow, and of creating a succession of talented leaders who can carry the company forward even after the current generation of leadership has moved on. Fisher pointed out that companies where the top leadership rules by fear, or talented people below them, are held back because the bosses are afraid of being overshadowed, where good people leave because they see no opportunity for advancement, these companies are storing up serious problems for the future because eventually the current leaders will retire or pass away. And if there is no strong team of capable successors ready to step into their shoes, the company will be in serious trouble. The ninth point is about whether the company has depth to its management, which is closely related to the eighth point, but goes a step further, asking whether the company's management team is broad enough and capable enough to handle the demands of continued growth. Because as a company grows larger and more complex, the demands on management grow too, and a company that has only one or two key people who really understand and drive the business is in a vulnerable position. Fisher said that a truly great company has built systems and structures that allow it to function well, even if one or two key individuals are lost, and has developed a team of capable managers who can handle the challenges of a larger and more complex organization. And when you talk to people at a company through the scuttlebutt method, one of the things you are listening for is whether the organization seems to be dependent on a single visionary leader, or whether there seems to be a deep bench of capable and talented people at many levels of the organization. The 10th point is about how good the company's cost analysis and accounting controls are. And this is a point that gets into the more technical aspects of how a company manages its finances. But Fisher's essential message here is simple, which is that a company cannot manage what it does not measure, and a company that does not have clear and accurate information about where it is making money and where it is losing it cannot make good decisions about where to invest more and where to cut back. Fisher said that the best companies have systems in place to track their costs very precisely across all parts of the business, so that management always knows which products, which customer segments, and which geographic markets are most profitable, and can direct resources toward the most productive areas and away from the least productive ones. And this kind of disciplined financial management is one of the things that separates genuinely excellent companies from merely decent ones. The 11th point is about whether there are other aspects of the business, somewhat peculiar to the industry involved, which will give the investor important clues as to how outstanding the company may be in relation to its competition. And what Fisher is really saying here is that every industry has its own specific dynamics and its own specific factors that determine who wins and who loses, and the serious investor needs to understand those industry-specific factors deeply before making any investment. For example, in the pharmaceutical industry, one of the most important factors is the pipeline of new drugs being developed, because a company whose current blockbuster drug is about to lose its patent protection and has nothing significant in development to replace it is in serious trouble, while a company with a rich pipeline of promising new drugs is in a much stronger position for the future. And this kind of industry-specific knowledge is exactly what the scuttlebutt method can help you develop by talking to scientists, doctors, and others who have deep knowledge of the pharmaceutical industry. The 12th point is about whether the company has a short-range or long-range outlook in regard to profits. And what Fisher is asking here is whether management is focused on making the next quarterly report look good, even if that means cutting corners or reducing investments that would benefit the company's long-term prospects, or whether management is making decisions with a view to what is best for the company over the next 5 or 10 or 20 years. Fisher was deeply critical of what he saw as the short-term thinking that dominated the behavior of many companies, where managers would cut research spending, reduce employee training, or delay necessary capital investments in order to meet a short-term profit target. And he said that this kind of short-term thinking is a major red flag for long-term investors, because a company that sacrifices its future to improve its present is ultimately destroying value, not creating it. The companies that Fisher most admired were the ones where management had the courage to make investments whose payoffs were years in the future, to accept some short-term pain in order to build a much stronger business over the long term, and to be honest with investors about what they were doing and why, rather than trying to make every quarter look as good as possible, regardless of the long-term consequences. The 13th point is about whether in the foreseeable future, the growth of the company will necessitate sufficient equity financing so that the larger number of shares then outstanding will largely cancel the existing stockholders' benefit from the anticipated growth. And what Fisher is really asking here, in simpler terms, is whether the company will need to issue a lot of new shares to fund its growth. Because when a company issues new shares, it dilutes the ownership of existing shareholders, meaning that each share represents a smaller piece of the company, and this can offset the benefits of the company's growth for existing investors. Fisher said that the best growth companies are those that can fund their expansion primarily from their own profits, rather than constantly needing to raise new money from investors, because this suggests that the business is genuinely profitable and efficient, that it generates more cash than it needs to keep running, and that it can therefore direct the excess toward growing the business without constantly asking existing shareholders to dilute their ownership. The 14th point is about whether management talks freely to investors about its affairs when things are going well, but clams up or becomes evasive when troubles and disappointments occur. And what Fisher is really asking here is about the honesty and transparency of management, because no company goes through life without facing difficulties, and the way management responds to those difficulties tells you a great deal about their character and their trustworthiness. Fisher said that the companies he trusted most were those where management was willing to be open and honest about problems, as well as successes, where they would acknowledge when something had gone wrong, explain what had caused the problem, and describe what they were doing to fix it, because this kind of transparency shows that management respects its investors and is confident enough in their strategy to be honest about setbacks, while companies that hide bad news or become evasive when problems arise are companies you cannot trust. And if you cannot trust management, you cannot really know what you own when you own their shares. The 15th point is about whether the company has a management of unquestionable integrity. And this is perhaps the most important of all the 15 points, because integrity is the foundation on which all the other qualities rest. A company can have great products, strong sales, excellent research, and wonderful labor relations. But if the management lacks integrity, all of those things can be corrupted and ultimately destroyed. Fisher explained that integrity in management means more than simply not breaking the law. It means treating all the company's stakeholders fairly. It means not enriching themselves at the expense of shareholders. It means being honest about both the good and the bad aspects of the business. And it means having a genuine and lasting commitment to doing what is right rather than what is merely convenient or profitable in the short term. He said that a management without integrity might produce excellent short-term results, but over the long term, their dishonesty will almost certainly catch up with them, whether through outright fraud, through the gradual erosion of the company's culture, or through the departure of talented people who do not want to work for people they cannot respect. And the investor who owns shares in such a company will ultimately pay a heavy price. Now that we have worked through all 15 of Fisher's points, it is worth stepping back and thinking about how to use them in practice. Because the obvious question is this: how can an ordinary investor actually research all of these things for any given company, especially when some of them seem to require access to insiders and industry experts that most people do not have? Fisher's answer, again, was the scuttlebutt method, and he was actually quite encouraging about the ability of determined individual investors to use this method effectively, because the information you need is often much more accessible than you might think. Industry conferences and trade publications are often open to the public or easily accessible. Competitors and former employees are often surprisingly willing to share their views. Customers can often be found through public channels, and analysts and researchers who follow a particular industry are often willing to talk to serious and well-prepared investors. Fisher also acknowledged that most investors will not be able to research every company to the depth that his 15 points require, and he suggested that it is better to invest in a smaller number of companies that you have truly researched deeply than to spread your money across a large number of companies that you only know superficially. And this leads us to one of his most important and most controversial ideas, which is his view on diversification. Most investment advisors recommend that investors diversify broadly across many different companies and industries in order to reduce risk, and this is the conventional wisdom that most investors have absorbed. But Fisher challenged this conventional wisdom in a very thoughtful and interesting way, not by saying that diversification is always wrong, but by pointing out that excessive diversification can actually increase risk for the investor who is doing serious research, because it forces you to spread your attention and your money across so many companies that you cannot know any of them really well. Fisher argued that if you have done your research properly and you have found genuinely great companies, you should concentrate your investments in those companies rather than diluting your position by also buying a lot of mediocre or unknown companies just for the sake of diversification, because the risk of owning a truly great company that you understand deeply is much lower than the risk of owning 50 companies that you only know superficially, because you have no real basis for judging whether any of those 50 companies are going to do well. He said that over-diversification is actually a way of acknowledging that you do not know what you are doing, because if you truly understood the companies you were investing in and had genuine confidence in their quality, you would not feel the need to own dozens of them. And while he acknowledged that some diversification is sensible to guard against the risk that even your best research could sometimes be wrong, he suggested that for most serious investors, owning somewhere between 5 and 20 genuinely great companies that you understand deeply is better than owning 100 companies that you have only looked at superficially. Now let us talk about the question of when to buy, because finding a great company is only half the challenge. The other half is knowing when to buy its shares, and Fisher had very interesting and useful things to say about this question as well. Fisher said that the ideal time to buy shares in a great company is when the shares are available at a price that reflects a reasonable valuation of what that company is worth today, combined with the expectation of significant growth in value over the coming years. And he acknowledged that this is not always easy to judge, because the market is always trying to anticipate the future, and shares in genuinely great companies are rarely cheap. He also said something that goes against a lot of conventional investment wisdom, which is that it is generally better to pay a fair price for a great company than to buy a mediocre company at a very cheap price, because the long-term returns of a genuinely great business will almost always far outweigh any initial premium you paid, while the mediocre company you bought cheap will likely stay mediocre or get worse, and your cheap purchase price will not save you from poor returns. Fisher gave examples of investors who had refused to buy shares in genuinely great companies because the shares seemed a little expensive at the time, only to watch those companies continue growing for years and years, with the shares going much higher. And he said that the mistake of not buying a great company because it seems a little pricey is far more costly in the long run than the mistake of paying a slightly higher price for quality. He also talked about buying during periods of temporary difficulty, and this is one of his most actionable and most powerful ideas, because even the greatest companies go through temporary periods of trouble, whether because of a temporary problem with a product, a short-term economic downturn, a management transition, or some other challenge that is real but not permanent. And these periods of temporary difficulty often cause the share price to fall significantly, even though the long-term prospects of the company have not really changed. Fisher said that these temporary downturns in great companies represent some of the best buying opportunities that long-term investors will ever find, because you are able to buy a great business at a temporarily depressed price. And if your research has confirmed that the underlying quality of the business remains intact and that the difficulties are genuinely temporary rather than permanent, then buying more shares during the downturn, rather than panicking and selling, is one of the most reliable ways to generate above-average investment returns. He gave examples of how some of the best investment opportunities he had ever seen came precisely during periods when the share price was falling and when most investors were frightened and rushing to sell. And he pointed out that the investor who has done deep research and has genuine confidence in the long-term quality of a business is the one who is best positioned to take advantage of these moments of market fear. Now let us talk about when to sell, because this is a question that trips up even experienced investors, and Fisher had very clear and very useful things to say about it, though his answer might surprise you. Fisher said that there are basically three good reasons to sell a stock, and very few others, and those three reasons are: first, you made a mistake in your original assessment of the company's quality, and the company does not actually have the qualities you thought it had. Second, the company has genuinely and permanently deteriorated in quality, perhaps because management has changed, the competitive environment has shifted in a fundamental way, or the company's growth opportunities have been exhausted. And third, you have found another company that is so clearly superior in its investment prospects that it makes sense to sell the first company and buy the second one, even though this should be done very rarely and only when the difference in quality and value is very clear and significant. What Fisher specifically said should not be a reason to sell is simply that the share price has gone up a lot, and this is where his thinking diverges sharply from the habits of most ordinary investors who tend to sell their winners and hold their losers, which is exactly the wrong strategy for building wealth. Because selling a great company, just because its price has risen, is cutting short your most successful investments, while holding your failures is dragging down your overall return. Fisher said that the tax bill you face when you sell shares in a profitable investment is often one of the most significant costs of active trading, and that many investors who trade in and out of their positions frequently are destroying a large part of their potential wealth through unnecessary tax costs, while the investor who buys a great company and holds it for many years allows the miracle of compounding to work uninterrupted, and the end result, over a period of decades, can be truly remarkable. He also addressed the temptation to sell during market downturns, and he was very clear that selling great companies during temporary market declines is almost always a mistake, because the market's short-term movements are essentially unpredictable, and the investor who sells during a downturn and waits to buy back when things look better will almost always find that the shares have recovered before they get back in, resulting in a net loss compared to simply holding through the difficult period. Fisher told stories of investors who had held shares in the same great company for 20 or 30 years and had seen their investment multiply many times over, and he compared this to investors who had bought and sold those same companies frequently, paying taxes and transaction costs with every trade, and who ended up far less wealthy despite all their activity. And the lesson he drew from this comparison was simple and profound, which is that for the investor who has done genuine research and found a genuinely great company, patience and inaction are often the most profitable strategies available. Let us now talk about Fisher's views on what investors should not do, because he dedicated a significant part of his book to warning investors away from common mistakes that he had observed destroying returns throughout his long career. And these warnings are just as relevant today as they were when Fisher first wrote them. One of the most important things Fisher said not to do is to buy into initial public offerings, or what are called IPOs, which are when a company first sells its shares to the public. And Fisher's reason for this advice was quite straightforward, which is that when a company goes public, it does so at a time and at a price chosen by its current owners and their investment bankers, who have a strong financial incentive to sell the shares at the highest possible price. And this means that IPOs are almost by definition sold at prices that are favorable to the seller and unfavorable to the buyer. He acknowledged that there are occasional exceptions, cases where a genuinely great company is selling shares at a fair or even attractive price. But he said these exceptions are rare, and that the investor who makes a habit of buying IPOs will more often than not be disappointed, because they are typically buying at a price set by people who have far more information than they do, and who are strongly motivated to get the highest price possible. Fisher also warned investors strongly against what he called the three maddest investment mistakes that investors commonly make. And the first of these is to buy a company simply because it seems cheap relative to its recent history. In other words, to buy something because it has fallen a lot in price without understanding why it fell and whether the reasons for the fall have been corrected. He pointed out that many shares that have fallen a lot in price have done so for very good reasons, because the business is genuinely declining, because the industry is facing structural challenges, or because management has made serious mistakes that are not easily corrected. And the fact that a share used to trade at a much higher price does not mean that the current lower price is a bargain. It may simply be that the lower price is where it now belongs, given its diminished prospects. The second of the three maddest mistakes is to follow the crowd, to buy what everyone else is buying just because everyone else seems excited about it. And Fisher was very direct in saying that the time when a particular investment idea is on the lips of everyone at social gatherings and in the financial press is usually the worst possible time to buy it, because by that point, all the obvious buyers have already bought. The price has risen to reflect the widespread enthusiasm, and there is very little upside left for the new buyer. Fisher said that the truly great investment opportunities are almost never the ones that are being talked about everywhere, because the market is reasonably efficient at incorporating widely known information into prices. So if something is widely known and widely discussed, it has almost certainly already been priced in, and the investor who buys at that point is usually paying too much, while the investor who is willing to do independent research and form independent views that differ from the crowd is the one who is most likely to find undervalued opportunities. The third of the three maddest mistakes is to buy something based on where you think the overall stock market is going, because Fisher was very clear that attempting to time the market, to buy when you think the market is going up and sell when you think it is going down, is a strategy that almost never works over the long term, because the market's short-term movements are essentially random and unpredictable, and the investor who is constantly moving in and out based on market predictions will almost always end up with lower returns than one who simply buys great companies and holds them regardless of short-term market movements. He said that even the most brilliant and experienced investors are wrong about market timing more often than they are right, and that the transaction costs and tax bills generated by frequent trading in response to market predictions are a significant drag on returns. So the wisest course for most investors is to completely ignore short-term market movements and focus entirely on the quality and prospects of the specific businesses they own. Fisher also warned investors against placing too much weight on past earnings records when evaluating companies, and this might seem counterintuitive because most investors do focus heavily on a company's historical financial performance. But Fisher's point was that the past is already over and cannot be changed, while what matters for your investment return is what the company will do in the future, and past performance, while relevant, can sometimes be misleading because the conditions that produced past success may no longer exist, while a company whose past has been mediocre may have recently made changes that set it up for a much better future. He said that the investor who is enslaved to historical financial data and who makes decisions purely on the basis of past numbers is missing the most important dimension of investment analysis, which is the qualitative assessment of what makes a company great and whether those qualities are likely to persist and strengthen in the future. And this is where the combination of the scuttlebutt method and the 15 points provides such a powerful advantage, because they direct the investor's attention toward exactly the things that will determine the company's future success. Fisher had very interesting things to say about the relationship between a company's research and development spending and its long-term investment appeal. and he was ahead of his time in emphasizing how important innovation and technological development would be for the future of American and global business. He saw clearly that the companies that would create the most wealth for investors over the coming decades would be those that were constantly pushing the boundaries of what was technologically possible and finding new ways to serve their customers and expand their markets. He used examples from the chemical and electronics industries of his time to illustrate this point, showing how companies that had invested heavily in research and development had created enormous value for their shareholders over the decades, not just from the products they had developed for existing markets, but from entirely new markets and applications that no one had anticipated when the research began. And he said that this ability to create unexpected value from research is one of the defining characteristics of the greatest investment opportunities. Fisher also talked about the importance of understanding a company's profit margins, not just as a snapshot at a single point in time, but as a trend over time, because a company whose margins are consistently improving over the years is one that is becoming more powerful and more competitive, while a company whose margins are trending downward may be facing increasing competition or losing its advantages. And the investor who understands this trend is in a much better position to judge the company's long-term investment prospects. He talked about the difference between companies that earn their high margins through genuine competitive advantages, such as proprietary technology, exceptional brand recognition, or unique distribution networks, versus companies that earn temporarily high margins in industries where competition is limited for now, but where new entrants will eventually appear and push margins down. And he said that the most durable and valuable investments are in companies whose competitive advantages are deep enough to sustain their margins over many years, regardless of new competition. Fisher spent a great deal of time in his book discussing the importance of management quality, and he came back to this theme again and again because he believed that management is ultimately the single most important factor in determining a company's long-term investment success, far more important than the specific products it is selling today or the industry it is in, because great management can navigate challenges, seize new opportunities, and build lasting competitive advantages, while mediocre or dishonest management can destroy even the most naturally advantaged business. He said that when he evaluated companies, he always tried to meet with top management personally, and that these meetings were not primarily about getting financial information, because financial information is available in public documents, but about forming a judgment about the character, the intelligence, the long-term vision, and the integrity of the people running the company, because these qualities would ultimately determine whether the company's future would match its potential or fall short of it. Fisher described what great management looks like in very specific and practical terms. He said that great managers are always honest about their company's weaknesses and challenges, not just its strengths, because only managers who are honest about problems can take the steps needed to solve them, while managers who deny or minimize problems are leaving them to fester and grow. He said that great managers are genuinely interested in learning and improving, not defensive about criticism or new ideas, and that great managers have a long-term orientation that leads them to make decisions based on what is best for the company over a 5 or 10-year horizon, rather than what will make the next quarterly report look best. He also talked about the importance of management having a genuine and lasting commitment to the company's employees, because he saw this commitment as both morally right and practically essential to long-term business success, since the company's employees are ultimately the ones who create the products, serve the customers, and drive the innovation that determines the company's competitive position, and a management that treats employees as disposable costs rather than valuable assets is undermining the very foundation of the company's success. Fisher talked about the role of the stock market itself in creating investment opportunities, and his view of the market was quite different from what you hear from many other investors and commentators. He saw the market not as a mechanism for efficiently allocating capital to its highest use, but rather as a market driven heavily by emotion and psychology, where prices are often far from the true underlying value of the businesses being bought and sold. He said that this emotional and psychological nature of the market is actually the greatest friend of the well-researched long-term investor because it creates situations where great companies become temporarily undervalued due to fear, panic, or simply a lack of understanding, and these situations give the patient and well-prepared investor the opportunity to buy genuinely excellent businesses at prices far below their long-term worth, and then to hold those businesses while the market gradually comes to recognize their true value and bids up the price accordingly. Fisher was also very thoughtful about the question of when to pay attention to the broader economic environment and when to ignore it, and his answer was somewhat nuanced. He said that while it is foolish to completely ignore the economic cycle, because some businesses are genuinely very sensitive to it, it is equally foolish to let fears about the economic cycle stop you from owning great businesses, because over any long period of time, the returns from owning great businesses will overwhelm any temporary losses caused by economic downturns. He said that the investor who refuses to buy shares in great companies because they are worried about the next recession is like a farmer who refuses to plant crops because they are worried about the possibility of bad weather. The sensible farmer plants the best crops they can on the best land they have and manages the risks that weather brings as they come, rather than refusing to farm at all because weather is unpredictable. And in the same way, the sensible investor buys the best companies available and manages the risks of economic cycles as they come, rather than staying out of the market entirely because economic cycles are unpredictable. Fisher also had interesting things to say about the question of growth versus value in investing. And while the modern investment world tends to treat growth investing and value investing as opposite approaches, Fisher himself saw them as deeply connected because a genuinely great company is always valuable at the right price. And if you find it at the right price, you are simultaneously a growth investor and a value investor because you are buying future growth at a value price. He said that the artificial distinction between growth and value investing often leads investors into confusion and error because it tempts value investors to avoid genuinely great growing companies on the grounds that they seem expensive, while it tempts growth investors to buy mediocre companies that are growing quickly but are overpriced and will never deliver good returns. And the wiser approach is simply to look for the best businesses you can find and buy them when they are available at reasonable prices without worrying too much about which camp your investment philosophy falls into. Now let us talk about the idea of growth companies more specifically, because the identification and purchase of genuine growth companies is really the central theme of the entire book. And Fisher spent considerable time explaining what a true growth company looks like, how to distinguish it from companies that are merely growing quickly for a short time before reverting to average, and why owning the shares of truly great growth companies over long periods is one of the most reliable ways to build significant wealth. Fisher said that a true growth company is one whose sales and earnings are expected to grow significantly faster than the overall economy, not just for a year or two, but for many years, and that this kind of sustained above-average growth, when combined with good profitability, leads to an exponential increase in the value of the company's shares over time through the mechanism of compound growth, where each year's earnings are reinvested in the business to generate even larger earnings the following year. He gave examples of companies that had demonstrated this kind of long-term compound growth and had thereby turned a modest initial investment into a remarkable sum over many decades. And he used these examples not to boast or to make investors feel that they had missed out, but to illustrate the profound power of compound growth and to explain why finding and holding the right growth companies is so much more important than trying to time the market or trade in and out of positions frequently. Fisher was also careful to distinguish between companies whose growth was driven by genuine and durable competitive advantages versus companies whose growth was driven by temporary factors such as a booming economy, a one-time technological advantage that others would quickly copy, or a passing consumer fashion that would fade as quickly as it had come, because it is only the first kind of company that is worth holding for the very long periods needed to fully capture the benefits of compound growth. He described the sources of genuinely durable competitive advantage in specific and practical terms, including proprietary technology that competitors cannot easily replicate, exceptional brand recognition that creates genuine customer loyalty, unique distribution networks that give the company access to customers that competitors cannot easily reach, significant economies of scale that allow the company to produce its products or services more cheaply than competitors, and a culture of innovation and customer service that constantly reinforces and extends these advantages over time. Fisher pointed out that these sources of competitive advantage are closely related to several of his 15 points, and that a company which scores well on most of his 15 points is almost certain to have strong and durable competitive advantages, because those points were specifically designed to identify the qualities that create and sustain competitive advantages over long periods of time. He also talked about the role of the stock market in valuing growth companies, and he made the interesting observation that the market often does a poor job of valuing long-term growth, because market participants tend to discount the future very heavily, focusing on what a company will earn in the next year or two, and placing very little value on what it might earn 5 or 10 years from now. And this tendency creates opportunities for the patient long-term investor who is willing to think over longer time horizons than the typical market participant. Fisher said that the patient investor who buys a truly great growth company and holds it for 10 or 20 or even 30 years will typically find that a large proportion of their total return comes from the later years of their holding period, when the compound growth has had time to accumulate into a very large base of earnings and value, and that this long tail of compound returns is something that impatient investors who sell early never capture. One of the most interesting and distinctive aspects of Fisher's thinking is his view on the role of the investor's own temperament in determining investment success, and he said quite directly that the right temperament is arguably more important than intelligence or analytical ability, because investing requires the ability to be patient when patience is uncomfortable, to be independent when everyone else is doing something different, to be calm when the market is in a panic, and to be persistent in doing careful research even when the research is difficult and time-consuming. He said that investors who are driven primarily by emotion, who buy when they are excited and sell when they are frightened, will almost certainly underperform regardless of how intelligent they are or how much analytical information they have access to. While investors who have the right temperament, who are naturally patient, independent-minded, and able to stay calm under pressure, will often outperform, even if they are not especially brilliant, because their temperament allows them to make better decisions at the crucial moments when markets are most extreme. Fisher also talked about the importance of the investor understanding their own limitations and being honest with themselves about what they know and what they do not know, because overconfidence is one of the most common and most costly mistakes that investors make. And the investor who thinks they know more than they actually do will take risks that they do not fully understand and will be caught off guard when things do not go as they expected. He said that the honest and self-aware investor who knows the limits of their knowledge will naturally gravitate toward the kinds of deep and careful research he advocated in his book, because they will understand that you cannot safely invest in a company you do not truly understand, and they will put in the work needed to genuinely understand the companies they are considering before committing their money to them. Fisher dedicated a significant portion of his later thinking to what he called the conservative investor, and he wrote a follow-up section to his 15 points about the qualities that the most truly conservative investors should look for. And the interesting thing about his definition of conservative investing is that it is quite different from the common understanding of the term, which tends to associate conservative investing with bonds and low volatility and staying away from stocks. Fisher said that truly conservative investing is not about avoiding risk in the short-term sense of volatility, but about building lasting and reliable wealth over the long term. And he said that the most conservative approach to building wealth is actually to own shares in genuinely great companies that are growing their earnings year after year, because this approach delivers both the income you need in retirement and the growth that protects your purchasing power against inflation, while bonds and other fixed income investments, while they seem safe in the short term, are almost certain to lose real purchasing power over long periods due to the erosive effect of inflation. He pointed out that an investor who had put all their money into government bonds 20 or 30 years ago would have received a reliable income, but the real purchasing power of that income would have been steadily eroded by inflation, while an investor who had put all their money into shares of genuinely great growing companies 20 or 30 years ago would have seen both their income and the real value of their capital grow substantially over time. And this is what Fisher meant when he described growth stock investing as truly conservative in the deepest sense. He also talked about the importance of the investor understanding the difference between risk in the short-term sense, which is the possibility that the price of your investments might fall temporarily, and risk in the long-term sense, which is the possibility that you will end up with less real wealth than you need to live comfortably or achieve your financial goals. And he argued that many investors are so focused on avoiding short-term risk that they accept far too much long-term risk by staying away from growth stocks and therefore losing out on the compound growth that is the most reliable path to long-term financial security. Fisher talked about the practical application of his 15 points and scuttlebutt method in the context of different types of companies and different industries, and he made some interesting observations about which kinds of companies are most likely to produce long-term investment success and which kinds are most likely to disappoint. He said that companies in what he called the fortunate and able category, meaning companies that are fortunate enough to be in industries with naturally attractive economics, and that are also well managed enough to exploit those economics effectively, are by far the best long-term investments because they have both the external environment and the internal qualities needed to sustain above-average growth over long periods. He said that companies in what he called the fortunate, because they are able category, meaning companies that are not necessarily in naturally attractive industries, but have such exceptional management that they have been able to carve out excellent positions and generate above-average returns, even in difficult industries, are also excellent investments, though they require more careful evaluation because the quality of management is so much more critical to their success. He was much more cautious about companies and industries with inherently poor economics, such as highly commoditized businesses where no single company has any pricing power, because even excellent management cannot fully overcome the structural disadvantages of a bad industry. And the investor who buys companies in structurally bad industries, hoping for a turnaround, will usually be disappointed. Fisher also talked about the role of patience in investment success, and he was extraordinarily emphatic on this point, returning to it again and again throughout his book, because he had seen so many investors destroy their returns by selling great companies too early, whether out of impatience with the time it was taking for the investment to work out, or out of fear during a temporary market decline, or simply because they could not resist locking in a profit once the price had gone up significantly. He said that the great paradox of investing in genuinely great companies is that the longer you hold them, the easier and less work it requires. Because once you have found a truly great company and bought it at a reasonable price, you do not need to do much of anything. You just need to stay out of your own way, reinvest any dividends, and let the company's management keep doing what great management does, which is building more and more value year after year. And the investor who can resist the temptation to do something, anything, with their holdings is usually the one who ends up with the best results. He told stories of investors who had bought shares in great companies in the 1940s or 50s and had simply held them through all the market ups and downs and economic crises and geopolitical events of the following decades, and who by the time he was writing his book had seen those investments grow into sums that seemed almost impossible when compared to the original investment. And the lesson he drew from these stories was not that those investors had been incredibly lucky, but that they had had the wisdom and the discipline to do what seems hard, but is actually the most rational strategy available, which is to find great companies, buy them at reasonable prices, and hold them for very long periods of time. Fisher also addressed the question of inflation and what investors should do about it, and his answer was consistent with his overall philosophy. He said that the best protection against inflation is to own shares in great companies that have the ability to raise their prices over time in line with or faster than inflation, because these companies will see their earnings grow in nominal terms over time, even if real growth is more modest. While the investor who holds cash or fixed income investments to avoid inflation risk will see the real purchasing power of their assets steadily eroded. He pointed out that genuinely great companies are often the best inflation hedge available because they have pricing power, meaning the ability to raise prices without losing customers, which is a function of the same competitive advantages that make them great companies in the first place. And this pricing power is something that few other investments can offer, making great growth stocks not just good investments for their growth potential, but also for their ability to preserve real wealth in inflationary environments. Fisher talked about some of the psychological challenges of long-term investing, including the challenge of watching your investments fall in value during market downturns without panicking, the challenge of holding a company through a period of temporary difficulty when the natural instinct is to sell and stop the pain, and the challenge of resisting the temptation to sell a great company that has already risen a lot in price, simply because you feel that the gain should be locked in. He addressed all of these challenges with the same basic answer, which is that they can all be overcome through a combination of genuine knowledge and conviction about the companies you own and the right temperament to apply that knowledge under pressure, because the investor who truly understands why a company is great and has genuine confidence in that assessment is much less likely to panic when the price falls, much more likely to see a temporary difficulty as an opportunity rather than a reason to sell, and much less likely to sell a winner simply because it has already gone up significantly. He also said that the process of doing deep research using the scuttlebutt method and the 15 points naturally produces a level of knowledge and conviction about your investments that is very difficult to achieve through superficial analysis, and that this depth of knowledge is not just intellectually satisfying, but also practically valuable, because it gives you the confidence to hold your positions through the inevitable periods of difficulty and uncertainty that every investor faces. Fisher talked about the role of dividends in investment strategy, and his view on this was interesting and somewhat contrarian. He said that dividends are generally less important than most investors believe, because the tax efficiency of capital appreciation is typically superior to the tax efficiency of dividends, especially in countries where dividends are taxed at higher rates than capital gains, and because a company that reinvests its profits in growing the business will typically create more total wealth for shareholders over time than a company that pays out a large portion of its earnings as dividends. He said that the investor who is focused on building long-term wealth should generally prefer companies that retain their earnings and reinvest them in the business at high rates of return, rather than companies that pay out a large portion of their earnings as dividends, because the retained earnings that are reinvested in a genuinely great business will compound over time at the high rates of return that the business generates, while dividends paid out and then reinvested by the shareholder can only compound at whatever rate the shareholder achieves with their reinvestment, which is likely to be much lower. He acknowledged that there are situations where dividends are valuable, particularly for investors who are living off their investment income in retirement and need regular cash payments, and he was not suggesting that dividends are never important, but he said that for investors in the wealth-building phase of their lives, the focus on dividend-paying companies often leads to overlooking genuinely great growth companies that pay little or no dividend because they have better uses for their earnings within the business. Fisher also talked about the importance of not being overly influenced by short-term fluctuations in a company's reported earnings, because earnings can vary significantly from quarter to quarter for reasons that have nothing to do with the underlying health and trajectory of the business. And an investor who panics when a company reports a lower than expected quarterly profit, or who becomes overconfident when a company reports a better than expected quarter, is likely to make poor decisions based on short-term noise rather than the long-term signal. He said that the truly important question is not whether earnings were above or below expectations in any given quarter, but whether the underlying competitive position, growth trajectory, and management quality of the company are intact and on track for the long term. And answering this question requires exactly the kind of deep qualitative understanding of the business that his 15 points and scuttlebutt method are designed to develop. Fisher was also one of the first investors to emphasize the importance of thinking about total return rather than just income or just capital appreciation. And he said that the wisest investors think about the total return from their investments, meaning the combination of dividends, if any, and capital appreciation over the holding period, and that this total return perspective helps investors avoid the mistake of sacrificing long-term capital appreciation in order to maximize short-term income, or conversely, of overlooking the contribution that dividends can make to total return when they are present. He said that the ultimate test of any investment is whether the total return you achieve over your holding period, measured against the risks you took to achieve it, and the alternatives available to you, is satisfactory, and that this total return perspective is the right way to evaluate whether your investment strategy is working and whether specific investments have been wise or not. Fisher made some observations about the investment industry itself that are as relevant today as they were when he first made them. He said that the financial industry tends to produce a lot of noise and a lot of activity because people who are busy and active seem more professional and more valuable than people who are calm and patient, and because brokers and fund managers make more money when their clients trade more frequently, but that all this activity is often actively harmful to investment results because it generates costs, produces tax bills, and leads investors to make decisions based on short-term emotions rather than long-term fundamentals. He said that the truly great investors are often the quietest and most patient ones, the ones who do their deep research carefully, make their decisions thoughtfully, and then have the discipline to stick with those decisions through the inevitable periods of doubt and discomfort that all long-term investors face, and that this quiet and patient approach is deeply at odds with the culture of the financial industry, which celebrates action and activity and constantly creates new stories and new excuses for investors to buy and sell. Fisher addressed the question of how ordinary investors, who do not have access to the same information and expertise as professional investors, can hope to compete in the investment arena. And his answer was actually quite encouraging because he said that the professional investment community has certain structural disadvantages that actually make it difficult for professional investors to fully exploit the opportunities that his 15 points and scuttlebutt method identify. He said that professional investors managing large sums of money are constrained by the need to diversify broadly, to maintain liquidity, to report good short-term performance, and to justify their decisions to clients and committees. And all of these constraints prevent them from doing the kind of concentrated, long-term, deeply researched investing that he advocated, because a professional managing a large fund simply cannot concentrate all their assets in 5 or 10 deeply researched companies and hold them for decades, even if they know that is the best strategy. Fisher said that individual investors who manage their own money, especially those with modest amounts to invest, actually have a structural advantage over professional investors in this respect, because they can concentrate their holdings in a small number of genuinely great companies, hold them for very long periods without worrying about quarterly performance comparisons, and make decisions based purely on the long-term fundamentals of the businesses they own, without any of the institutional constraints that burden professional investors. He used this observation to encourage individual investors not to feel intimidated by the professional investment world, but to instead recognize that by doing the kind of deep, qualitative research he advocated, and by having the patience and discipline to hold their best investments for very long periods, they could achieve returns that would compare very favorably with those of professional investors. And he backed this claim with examples from his own long career of watching individual investors achieve outstanding results through exactly this approach. Fisher also had interesting things to say about the role of luck in investment success, and he was honest in acknowledging that luck plays some role, because even the best research and the best judgment cannot anticipate every unexpected development that might affect a company's fortunes, and some investments will turn out worse than expected simply because of unforeseeable events that could not have been avoided through better research. But he said that while luck plays a role in individual investments, it plays a much smaller role in overall investment results over long periods, because the law of large numbers tends to average out the effects of luck over time. And what determines whether an investor succeeds over a career is not whether they were lucky in any individual investment, but whether their overall approach, their research method, their criteria for selection, and their discipline in holding and selling is sound. He said that the investor who has a sound and well thought out approach, like the one he described in his book, will, over time and across many investments, achieve results that reflect the genuine quality of their analytical and emotional discipline, regardless of the occasional unlucky outcome that even the best approach will sometimes produce. And this is the fundamental argument for taking investment seriously as an intellectual discipline rather than treating it as a game of luck. Fisher concluded his major themes with a reflection on the relationship between investment and society more broadly, and he said that genuinely great companies are great not just for their shareholders, but for the societies in which they operate, because they create jobs, develop new technologies, solve customer problems, and drive economic progress. And the investor who identifies and supports these genuinely great companies through long-term ownership is doing something that is not just personally profitable, but also socially valuable. He said that the idea of investment as a purely selfish activity is wrong, because the long-term investor who supports great companies through patient ownership is helping to channel capital toward the most productive uses in the economy, and is helping to ensure that genuinely great management teams are rewarded for their excellence, creating incentives for others to build and maintain great companies. And this positive social dimension of long-term investment in great companies was something Fisher felt strongly about and wanted his readers to understand. Fisher also described how his own investment philosophy had evolved over the course of his career, and this personal reflection is one of the most valuable parts of the book, because it shows an investor who was always willing to learn and to revise his thinking in the light of new experience, who made mistakes and learned from them, and who grew steadily wiser over the decades of his career. He described how early in his career he had focused too much on financial numbers and not enough on management quality and competitive dynamics, and how he had gradually learned through experience that the qualitative factors he eventually codified in his 15 points were actually more important determinants of long-term investment success than any financial metric, because the financial metrics were themselves the result of the qualitative factors, and understanding the qualitative factors allowed you to predict the future financial performance rather than just measuring the past. He also described how he had learned the hard way about the importance of holding great companies through periods of temporary difficulty, having sold companies too early on several occasions, and then watched them continue to grow spectacularly for many more years, and how these painful experiences had reinforced his conviction that patience and long-term thinking are the most important virtues in the successful investor's toolkit. Fisher's book also contains some practical guidance on how to structure and manage an investment portfolio using his approach, and while this guidance was written decades ago, most of it remains very relevant and practical today. He recommended that investors focus their attention on a small number of genuinely great companies that they have researched deeply, rather than spreading their money across many companies that they know only superficially. And he suggested that for most individual investors, a portfolio of somewhere between 5 and 20 companies that have been carefully selected using his 15 points and scuttlebutt method is likely to produce better results than a much larger and more diversified portfolio of less carefully researched companies. He said that investors should revisit their portfolio holdings regularly, not with the intention of trading, but with the intention of making sure that the qualities that made them buy each holding in the first place are still intact. Because occasionally, a company that was genuinely great when you bought it will stop being great. Perhaps because the competitive landscape has shifted. Perhaps because management has changed. Or perhaps because the industry has entered a period of structural decline. And in these situations, you should sell regardless of what has happened to the price since you bought. He also said that investors should resist the temptation to constantly add new ideas to their portfolio just because they have found something interesting, because the cost of adding a mediocre new idea is not just the money you put into it, but also the attention and emotional bandwidth you take away from managing your existing holdings. And since the number of truly great companies is always much smaller than the number of interesting companies, the discipline of focusing only on the truly great ones is essential to achieving the best results. Fisher talked about the importance of continuous learning for the successful investor, and he said that the investment world is always changing. New industries emerge, new technologies create new opportunities, competitive landscapes shift, and the investor who stops learning and relies entirely on their existing knowledge will eventually be caught out by changes they did not anticipate, while the investor who maintains a genuine curiosity and keeps developing their understanding of business and industry will continue to find new opportunities and to deepen their appreciation of the ones they already own. He recommended reading widely, not just in the financial press, but in scientific and technical publications, in business histories, and in any other source that helps you understand how businesses work, how industries evolve, and what makes some companies genuinely exceptional, while others are merely average, because all of this knowledge contributes to the investor's ability to evaluate new opportunities and to make better decisions about the companies they already own. Fisher also talked about the importance of intellectual honesty in investing, which he defined as the willingness to admit when you are wrong, to revise your views in the light of new evidence, and to sell a holding that has turned out to be a mistake rather than stubbornly holding it because you do not want to admit that you were wrong. Because he said that the ego protection instinct, the unwillingness to admit mistakes, is one of the most costly psychological tendencies that investors have to overcome. He said that the investor who can say clearly and honestly, "I was wrong about this company," and can then sell it and move on to better ideas without excessive self-recrimination, will always outperform the investor who holds on to a losing position because selling would require admitting a mistake. And he encouraged investors to think of their investment decisions not as permanent commitments of their identity or pride, but as hypotheses that are always open to revision in the light of new evidence. One of the most memorable and enduringly relevant passages in Fisher's book is about the psychological challenge of watching a stock you have been researching and are interested in buying go up in price before you have had a chance to buy it. And he said that this experience, which every serious investor will have many times, should be handled with great equanimity and perspective. Fisher pointed out that if a company truly qualifies as a great investment based on all his 15 points and the information gathered through the scuttlebutt method, then it will still be a good investment, even if you have to pay a somewhat higher price than you would have liked, because the qualities that make it great will produce returns over many years that will far outweigh the difference between the price you wanted to pay and the price you actually had to pay. And conversely, if a company's price has gone up so much that it genuinely no longer represents good value, even considering its growth prospects, then it was never going to make you as much money as a company that still offers good value, and there will always be other opportunities. He said that the investor who refuses to buy great companies because they miss the ideal entry price, who watches great companies continue to grow for years and years while waiting for a price that never comes, is making a fundamental error in thinking about what creates investment returns, which is not clever market timing, but rather the compound growth of genuinely great businesses over long periods, and that a somewhat higher entry price simply means that the compounding starts from a slightly higher base, which makes very little difference over a holding period of 10 or 20 or 30 years. Fisher's approach to investment research was also shaped by a deep respect for the complexity of business, and he warned investors against oversimplifying their analysis of companies, against reducing their evaluation to a small number of financial ratios or a checklist that could be applied mechanically without genuine understanding. He said that the 15 points he had identified were intended as a framework for thinking, not as a mechanical checklist where you simply count how many boxes are ticked and buy if the number is high enough. Because the real value of the framework lies in the depth of understanding. It helps you develop about each company you are evaluating, and a superficial application of the framework without genuine understanding of what each point means and why it matters is likely to lead to poor decisions. He emphasized that investing in great companies requires genuine intellectual engagement with the businesses you are evaluating, a real curiosity about how they work, why they are good at what they do, what threats they face, and how management is responding to those threats, and that this kind of genuine intellectual engagement cannot be replaced by formulas or algorithms, because the most important factors in long-term investment success are the ones that are most difficult to quantify. Fisher also addressed the question of international investing and whether his principles applied outside of the United States, where his original research was focused, and he said that while the specific companies and industries would be different in different countries, and while some of the information gathering techniques of the scuttlebutt method would need to be adapted to different cultural and business environments, the fundamental principles he had identified were universal. He said that genuinely great companies exist in every major economy, that the qualities that make companies genuinely great are the same everywhere: strong management, commitment to research and development, good labor relations, ethical behavior, long-term orientation, and genuine competitive advantages, and that investors in any country can benefit from applying his 15 points and scuttlebutt method to the companies available to them in their own markets. Fisher's legacy in the investment world is difficult to overstate, not because of the spectacular financial returns he achieved for his clients, though those returns were genuinely outstanding, but because of the quality and durability of the ideas he articulated in his book and in his teaching, ideas that have influenced generations of investors and that continue to be relevant and valuable decades after he first put them on paper. The key ideas of his book can be summarized as this: find genuinely great companies by doing deep qualitative research using the scuttlebutt method and his 15 points. Buy them at reasonable prices without worrying too much about precise timing. Hold them for very long periods and resist the temptation to sell unless the fundamental quality of the business has genuinely deteriorated. Focus on a small number of genuinely great companies rather than diversifying broadly into mediocre ones, and maintain the right temperament by being patient, independent-minded, and emotionally calm even during periods of market turbulence. These principles are simple to state but genuinely difficult to practice because they require the investor to go against their natural instincts at almost every turn, to do deep research when superficial analysis is easier, to concentrate when diversification feels safer, to hold when selling feels more decisive, to stay calm when panic is contagious, and to think long-term when the short term is what everyone around you is focused on. But the investors who have managed to consistently apply these principles throughout their careers, including Fisher himself and the many great investors who have been influenced by his work, have achieved results that are truly remarkable, building wealth not through cleverness or luck, but through genuine intellectual discipline, careful research, and the patient application of sound principles over long periods of time. The story that Fisher tells through his book is ultimately a deeply optimistic one, because it says that the ordinary investor who is willing to do real work and to think independently and to be patient can achieve extraordinary financial results, not by beating the market through superior information or analytical cleverness, but by developing a genuine understanding of great businesses and having the discipline to hold them through the inevitable periods of doubt and difficulty that all long-term investors face. He believed, and his long career provided strong evidence for that belief, that the stock market ultimately rewards genuine quality, that the shares of truly great companies will over long periods rise to reflect the growing value of those businesses, and that the investor who identifies those companies early, buys them at reasonable prices, and holds them through all of life's inevitable changes and challenges will accumulate wealth far beyond what most people believe is possible for an ordinary individual investor. This is the great promise of common stocks and uncommon profits, and it is a promise that has been kept for thousands of investors who have taken Fisher's ideas seriously and applied them with discipline and patience over the years. And there is every reason to believe that it will continue to be kept for investors who take his ideas seriously and apply them with the same discipline and patience in the years and decades to come. The world has changed enormously since Fisher first wrote his book. New industries have emerged. Technology has transformed the way businesses operate and compete, and the flow of information has accelerated enormously. But the fundamental principles Fisher identified have not changed, because they are grounded not in the specifics of any particular era or industry or technology, but in the timeless principles of what makes businesses genuinely great and what makes investments genuinely rewarding over long periods of time. The companies that will make the greatest investments over the next 20 or 30 years, just like the companies that made the greatest investments over the past 20 or 30 years, will be the ones that have outstanding management with integrity and long-term vision, that are committed to genuine research and innovation, that have strong and lasting competitive advantages, that treat their employees well and build loyal customer relationships, that have room to grow their sales and earnings significantly over many years, and that are willing to be honest and transparent with their investors even when things are not going well. These are exactly the qualities Fisher described in his 15 points, and the investor who learns to identify them and to evaluate them honestly and deeply through the scuttlebutt method will be well equipped to find and hold the great companies of the coming decades, just as Fisher and his students were equipped to find and hold the great companies of the decades past. So if you take one thing away from this summary of common stocks and uncommon profits, let it be this: the path to genuinely outstanding investment returns is not clever trading, not market timing, not following the crowd, not chasing hot tips, but rather the patient and disciplined pursuit of genuinely great companies through deep and honest research, bought at reasonable prices, and held for very long periods of time, with the calm and independent temperament that allows you to stay the course when the inevitable storms of market uncertainty make you doubt yourself. That is the essence of Philip Fisher's wisdom, and it is wisdom that has stood the test of time, not because investing is easy when you follow these principles, but because it is true, genuinely and lastingly true, in the way that only the deepest and most carefully tested ideas ever are. And for any investor who is willing to take the time to understand and apply these principles, the results over a lifetime of investing can truly be uncommon in the most rewarding sense of that word.